Well, let's dive right into this explainer. Today, we're unpacking a devastating but honestly almost completely forgotten financial catastrophe. Seriously, have you ever wondered if history is quietly repeating itself literally right under our noses? We're going to look at the data, the market psychology, and the brutal fallout of a historic crash just to see if our modern market is walking blindly into the exact same trap. So, welcome to our deep dive into the 1973 crash and the modern tech echo. It's really no secret that history repeats itself. And when it comes to the stock market, investors will do absolutely whatever mental gymnastics they need to convince themselves that this time it's different. Actually, legendary investor Sir John Templeton, who, by the way, averaged a staggering 15% annual growth for 38 years, called those the four most expensive words in the English language. Looking at the source material, it's a stark reminder that nothing empties a brokerage account faster than blind optimism dressed up as financial genius. And this brings us to Jesse Livermore. He was a pioneer of speculative trading, the inspiration for reminiscences of a stock operator. He made absolute fortunes shorting markets during crashes, and he warned us. He warned that there is nothing new on Wall Street. Speculation is as old as the hills. Whatever is happening today, yeah, it's happened before. Okay, to really understand this bubble, the one nobody talks about anymore, we've got to start our timeline in the late 1960s. The United States was right in this massive 20-year economic sugar high right after World War II ended in '45. Factories were booming, new suburbs were sprouting up overnight like wildflowers. Americans felt invincible. They had money, they had confidence, and, well, they had blind optimism. And really, why wouldn't they? The U.S. had beaten Germany, put a man on the moon in '69, and, maybe most importantly, invented the Etch-a-Sketch. Life was just good. And sitting right in the middle of all this optimism was the stock market, which had surged an unprecedented 350% by 1970. So the absolutely crucial point here is how this unprecedented, roaring bull run birthed a brand new investing strategy. It popularized what became known as one-decision stocks. The concept was incredibly simple, almost too simple. You invest in companies that are so powerful, so dominant, that you literally only have one decision to make when investing in them. Just buy. You never, ever sell. These stocks became known as the Nifty 50. Now, to be fair, these weren't risky penny stocks. They were household blue-chip names with incredibly stable cash flows. Think Coca-Cola, American Express, McDonald's. Investors truly believed these companies were entirely bulletproof. But, and this is the golden rule you've got to remember, if something sounds like a guaranteed, no-brainer investment with zero downside, it's almost always a financial grenade with the pin already pulled. And sure enough, that never-sell mentality quickly pushed the Nifty 50 into absolute fairy tale valuations. While the average price-to-earnings, or PE, ratio for the overall market at the time was a humble, perfectly respectable 15, a normal number you could bring home to your parents, the darlings of the era were soaring. Xerox was trading at 49 times earnings, McDonald's was at 86, Polaroid was at an astronomical 90 times earnings. On average, the whole Nifty 50 was trading at a jaw-dropping 42 times earnings. They were priced as if gravity just didn't affect Wall Street anymore. No way could that last, right? Well, this extreme market concentration meant that by the time we hit the peak in 1972, the top 5 Nifty 50 stocks made up a quarter of the entire market. Think about that. Just 50 stocks were eating up roughly 45% of the total U.S. stock market. To put that into perspective, with every single dollar an everyday investor put into a broad market index fund, they were basically making a massive bet that these specific 50 companies would somehow miraculously grow into the ridiculous price tag slapped on them. Then came 1973 and 1974. The financial grenade finally went off. Reality walked in and slapped everyone right across the face as these severe macroeconomic dominoes began to fall, one by one. Oil prices completely quadrupled. Inflation, which had been sitting super low, suddenly surged from 3% up to over 11%. Unemployment doubled from 4.5% to 9%. Oh, and President Nixon effectively ended the gold standard for good. The perfect storm had officially arrived. Now, when the broader economy falls apart like that, overpriced stocks don't just gently correct, they get completely obliterated. Between 1973 and 1974, the stock market plunged 50%. It was the absolute worst bear market since the Great Depression. And what about the untouchable Nifty 50? Coca-Cola shares plummeted over 60%, McDonald's fell over 70%, and Polaroid completely obliterated. Their shares collapsed by more than 90%. Those so-called bulletproof one-decision stocks turned into one giant financial obituary. But here is the real gut punch for you. 8. The damage wasn't quick. This wasn't some cute little V-shaped recovery like the one we saw after the recent pandemic. It took an agonizing 8 years, all the way until 1981, for the market to simply crawl back to the exact same level it had been at right before the bubble popped. 8 years. Investors who thought they were buying eternal, perfectly safe growth stocks ended up trapped in a decade of pure financial purgatory. Okay, let's fast forward to the present day and see how this all builds. If you're looking at the current state of the market and getting a slight, uncomfortable sense of déjà vu, you are definitely not alone. Mark Twain famously said, "History does not repeat itself, but it does rhyme." So let's look at the data together. While today's stock market isn't completely identical to 1972, it undeniably rhymes with it. And it's fascinating to unpack exactly why. Today, we're basically watching a movie with the exact same plot, just with much shinier special effects. Our modern U.S. tech giants, widely known as the Magnificent Seven, we're talking Microsoft, Apple, Google, Amazon, Meta, Tesla, and Nvidia, they now make up around 36% of the entire S&P 500 index. Just 7 companies are carrying the weight of the entire stock market. If that feels eerily familiar to the 45% concentration of the Nifty 50 we just talked about, well, it's because it is. And what about the valuations of these modern-day tech giants? Surely we've learned our lesson, right? They've got to be priced fairly. Not at all. The valuations are sky high. Apple trades at 37 times earnings. Nvidia is at 50 times earnings. And Tesla's up at a staggering 247 times earnings. These modern tech innovators are priced exactly like the Nifty 50 were, acting as if gravity simply doesn't affect Wall Street anymore. Even if we break down the rest of the Magnificent Seven multiples, we see Google and Meta sitting at 28 times earnings, Amazon at 35, and Microsoft at 38. Now let's be real. Are these solid, highly innovative companies that absolutely dominate their industries? For sure, yes. But are they also overpriced, overweighted, and worshipped by the market as if they are entirely bulletproof? Also yes. This shows you exactly how much blind optimism is baked right into the prices of these undeniably solid companies. Honestly, when we compare the two eras side by side, the echo is practically deafening. Yes, the Magnificent Seven are incredible innovators, but hey, so were Xerox, Polaroid, and Avon products back in 1972. Both groups of companies were worshipped as immortal, untouchable blue chips that would just grow forever and ever. The Magnificent Seven have truly become the modern echo of those one-decision stocks. Today's investors are acting like there's only one decision to make when it comes to these tech giants. Just buy, right? Which brings us to the brilliant wisdom of Warren Buffett. He summed up this whole phenomenon best when he said, "What we learn from history is that people don't learn from history." Investors today are literally tucking themselves in and telling themselves the exact same bedtime story as they did right before the 1973 crash. We are once again staring at a massively top-heavy market, pretending that valuations don't matter because, hey, the companies are just that good. So I want to leave you with a question to really think about. All we are missing right now is for a couple of macroeconomic dominoes to fall, and we could be right back where we were 50 years ago. Look at today's market. Look at the extreme concentration. And ask yourself, are you falling for the trap? Are we once again whispering the 4 most expensive words in the English language? This time, it's different. Thank you so much for joining me for this explainer. Keep your eyes on the data and stay curious.